Hello, everyone, and welcome to DealMaker's Crowdfunding Reg A Direct to NASDAQ. We've got a very good group today, the real powerhouses in Reg A to NASDAQ, and we're going to go around the room and let everyone introduce themselves for a minute. I'm Gene Massey with MediaShares. We help companies with their Reg A offerings, and I'll turn it over to Andrew.
Thanks, Gene. Andy Hall with NASDAQ. I'm glad my firm made the title, so I appreciate that. I've been at NASDAQ since 2004. I've had various roles in market intelligence, relationship management. Since 2007, I've been on the new listings team and really have worked with all levels of new listings. I work on the business development side, so that's IPOs, Reg A's falling in with that, companies looking to uplist, dual list, and transfer. So, know the whole process in close detail. And thanks for having me here.
And Mark?
Thanks, Gene. I'm Mark Elenowitz, and I'm a managing director at a firm called Digital Offering. And my team was one of the original creators of the ability for Reg A to actually trade on a national securities exchange. Although we tried to make NASDAQ the first one, we actually listed the first Reg A ever on a national exchange on the NYSE, and we did the only two that have ever been listed there, as well as several on the NASDAQ. So myself and Keith, who you'll meet in a few moments, and Lou and some of the others, we've all been pioneers in providing liquidity for Reg A issuers. And we're excited here to talk about the opportunity and how in today's marketplace, Reg A is a great alternative to other traditional financings and offerings, and how it offers the investors the ability to participate finally side by side with Wall Street, and really just what I used to coin the term leveling the playing field.
Now, Keith?
Great. Thanks, Gene. And thanks, everyone, for attending today's webinar. I'm Keith Moore, CEO of Boustead Securities. As Mark had mentioned, we've got a lot of experience in and around Reg A Plus offerings, working with this group on several before. We were actually the first firm to list a Reg A Plus offering on NASDAQ back in 2016 already. And we've been very active in and around the space since then. And we kind of have built our regulatory infrastructure to support them. We actually have one of the few firms that in the Boustead family that's approved by FINRA and the SEC to actually custody the cash around a crowdfunded offering. So investors can come into, it's called Sutter Clearing. Investors can come into Sutter Clearing through a Boustead underwritten Reg A Plus offering, and they essentially never have to leave the platform. And when those companies go public, they can then transfer their shares into another Boustead affiliate to be able to trade those in the aftermarket. So we've been doing this a long time. We're thrilled to be a part of today's webinar, and look forward to the discussion and the follow-up questions.
Great. And Lou?
I'm Lou Taubman. I'm the managing partner of Hunter Taubman, Fisher & Lee. We are a boutique SEC/capital markets focused law firm. The headquarters is in New York. We also have offices in Washington, D.C. and Miami. We are one of the leaders in the small cap IPO space. This first quarter, according to Renaissance Capital, we were the #2 firm in the country and #3 worldwide for IPOs on the issuer side. We're also quite active on the underwriter side. I've had the pleasure of working with both Keith and Mark on numerous offerings, including some Reg A Pluses. And happy to be here today. Thank you, Gene.
And Matt?
Hi, everyone. Matt Goldstein. I'm one of the founders of the DealMaker group of companies. DealMaker is a software company, first and foremost. It's a platform that issuers use to run online capital raising in a similar way that they run online product marketing campaigns. Some people call us the Shopify of the capital markets. We've hosted over 200 offerings in the last 12 months where issuers build their communities online and turn those communities into a source of capital. Over $1.7 billion processed over the last 12 months in offerings such as Reg A, which we'll talk about today, Reg CF, 506C, basically the offerings that have been unlocked by the 2012 Jobs Act, which was a big part of the reason I started this company with my co-founder. My previous life was practicing securities law at a New York law firm.
Well, Matt, since your firm DealMaker hosts a lot of Reg A offerings, as a matter of fact, you're hosting one of my clients' Reg A's right now. So tell me, if I host on DealMaker, tell me exactly how that would work, because I know you can attract brokers to work with you as well.
So DealMaker's mission in life is to bring online capital raising mainstream, right? There used to be a world where, doing an offering, whether it was a private placement that was intermediated by an investment bank or, one where the founders went out to find their capital themselves, it was a world of, road shows and presentations and trying to build relationships with investors in an old school way. And what we've been able to merge is the modern techniques of e-commerce, where every brand knows how to build a following. Every founder who's selling a product has a newsletter or an Instagram or some way to win the trust and build engagement with a group of followers. We've merged that with the traditional world of capital raising so that on our platform, brands can build communities and turn those communities into a source of capital by having them not just buy product, but also invest in an offering. So, if you pose the question, what would an offering look like on our platform? A lot of the answer resides with you. It depends on how you want to market the offering. We own a broker dealer, we own a transfer agent, we own a full stack marketing agency. We have all of the modern payment processing capabilities that you'd expect for any e-commerce solution. We're mobile optimized, and we work with brands and we work with founders to help them build communities and engage with those communities and turn them into a source of capital.
Well, traditionally, people have marketed their Reg A offerings online using ads and things like that. Now you're able to work with brokers like Mark and Keith in order to get larger investments and more investments. They bring deals to you. Is that correct? Can you tell us a little bit about how that works?
Yeah. So if you look at the scale of the U.S. capital markets, right, the amount that's raised by issuers directly online is like statistically negligible. But 5 years ago, it was zero. 10 years ago, it was zero, right? I've kind of lost track of when we all started. And I think if we all agree on a vision of the world where online capital raising is mainstream, then it's going to take teams, it's going to take groups, it's going to take syndicates, it's going to take cooperation. A brand might come to us and want to turn their community into a source of capital, but they're also going to need Mark to help them open up doors or pathways to capital that they wouldn't be able to do themselves. And they might also need Keith, right, for relationships and what some people in the capital formation world call distribution, right? How do you get your offering into the hands of people who want to buy it? And so we see a world where collaboration, transparency and collaboration become very normal amongst different facilitators of capital formation. And that's the way that somebody can take advantage of the rules around Reg A, which let you raise up to $75 million. In my view, it's very hard for an issuer to gather $75 million themselves. It takes a team and it takes a network.
Yeah. Now, Mark, you and Keith both pioneered Reg A's, and Keith, I'll get to you in a second. But Mark, I know we've talked a lot about how the trouble you had initially with Reg A's going to NASDAQ. Can you tell us a little bit about how you first got started bringing Reg A's to NASDAQ?
Yeah, I mean, when Jobs Act came out, I used to go to a lot of the conferences and sit on panels on the webinar and go to webinars and the various events. And everybody that was out there were kind of experts because they said so on LinkedIn, but they had never really done a deal. And they didn't understand the complexity in order to facilitate a capital raise and be able to integrate what we would call non-traditional type of marketing, what Matt had just talked about, and see a convergence with traditional Wall Street. So we had developed the methodology to allow investors to participate in what appears to be almost similar to a firm commitment underwriting, because the way we were able to do transactions and the way we currently do them is we make it look, act, and feel like a traditional IPO. It's one thing in order to get the street involved, and it's another thing to get the crowd. But the street doesn't like to utilize the tools and techniques that the crowd is used to, for instance, using credit cards or going into an escrow account. Wall Street works in syndicate. Wall Street works in a way where they settle through DTC and they settle broker to broker, all terms that the crowd probably isn't familiar with, but it's the plumbing of Wall Street. And as Keith had mentioned, his firm uses the ability to custody cash. We had a no action letter from the SEC that allows us to custody cash with our clearing firm that enabled investors to be able to participate and buy. So the challenges that we had was also educating the regulators and educating the exchanges, because when I first approached the New York Stock Exchange about this, they laughed at me and said, "Are you kidding me? Isn't this the flying cars and the nonsense that is out there?" And when we explained that it was basically a modern way of using modern techniques in order to sell securities, and it really brought the world into the 20th century, because the reality is when you do an S1, you have to go into a quiet period. In S1, you can't leave materials behind. It's very constrictive in terms of what you can do and how you can communicate. And that doesn't work in a modern world where everybody uses Instagram and Facebook and everything that's happening real time, because information would get out that probably the lawyers, the regulators, and the bankers would be very unhappy with. But unfortunately, in this modern communication world, it would occur. Reg A allows the ability now to be able to market and use general solicitation and use modern techniques. You're still disclosing all the risk factors. You're still giving investors informed decisions and allowing them to make informed decisions by that disclosure, but you're getting it to them in a new modern way of being able to go on Instagram and see a 30-second ad and then click on it to learn more. So the challenges that we had was going to Wall Street and saying, "Hey, we have this new idea. And by the way, price discovery, what you're used to, where we come out and tell you that we want to do a $10 deal and you bid us $6, it's not going to work here because Reg A is fixed price." So when we did the first one, it was literally beg, borrowing, and a lot of begging. And we only ended up having out of it was originally a $12 million deal. We closed at $8 million, and we had $200,000 of institutional interest. It really didn't go over well with the Wall Street community. The deal ended up closing, and 3 days later, it was a triple and traded millions of shares, and everyone made money. The next deal, it was 6 times oversubscribed, and we had 50% institutional coverage, which we ended up cutting the institutions back because the whole idea was to level the playing field for the little guy, not let the institutions get what normally the Wall Street doesn't get, or rather Main Street. So that was some of the challenges that we had to go with. And now as we've seen the market evolve, it's become more and more mainstream. We're in the market with DealMaker on a deal that's going to be closing on May 10th. That's listing on NASDAQ. We already have over 9,000 investors. That's a purely diversified deal. It truly shows what democratization of offerings should be. And the last deal we did, we had 48,000 investors, not 300, wow. Not 400, 48,000.
Wow. Now, Keith, you were one of the very first Reg A's on NASDAQ. You must have had some serious headwinds for that. Can you tell us about that? And what do you see it being now compared to then? Have you seen everybody go, "Oh, Reg A, okay, sure, why not?" Or is there still some resistance?
Well, yeah, back then, none of the Mark described it as the plumbing really existed, or it wasn't very efficient. So, there was just challenges to try and get people into deals, get them through deals. Now that's all in place, and it runs very, very smoothly. So that's been a real positive development, since 2016. But also just the familiarity with what Reg A Plus is. Back then it was all new. And investors generally like familiarity. So when you give them something new, it just gives them extra pause. And that was clearly the case with the Reg A Plus offerings back then. But they did attract interest, like Mark had described, with some of the offerings that they had done. and that had performed very well in the aftermarket. And so that just kind of stimulated the market that much more. And since then, there's been obviously more and more companies using Reg A Plus, both to raise money essentially privately, but then also to list. And so the investors have become much more comfortable with Reg A Plus in general. And as we've learned, it really comes down to the quality of the company that's raising the capital, and the better quality capital that companies that raise Reg A Plus usually tend to do better. So that's kind of where we focus our efforts. Today the market's obviously very challenging today, regardless of the type of offering you're doing. But generally, the higher quality companies are still attracting investor interest. So that's kind of where our focus has been more recently, and then also helping a few companies that have used Reg A Plus to list on NASDAQ in particular.
Now, Andy, I've got a Reg A. I want to bring it to NASDAQ. Do you go, oh, yeah, sure. Why not? Here's the sign here. Or do you go, oh, my gosh, a Reg A, what are we going to do? Or do you guys, have you read the listing requirements? I mean, what is your reaction now if I bring you a Reg A?
Sure. Just as Mark described, our listing qualifications area, which is the regulatory piece of NASDAQ, I work on the business development side. They looked at the disclosures of the Reg A, and I think they saw if it was a tier 2, the disclosures were enough just to see for filing an S1 that it would meet our standard. So the company can move forward with the filing of the one Reg A, do the offering, file an 8H12B to be a registrant under the 1934 Act, and then from there on do 10Qs, 10Ks, just like everyone else. But to answer your question, Gene, there's all different ways that a new listing can come to NASDAQ. It could be through a merger into a SPAC, or into a reverse merger into a shell, or acquiring a Canadian company and then dual listing, or taking this vehicle and listing on NASDAQ that way. I think some of the selling points, as the panelists will probably highlight, it's a little bit less money, from a cost perspective versus filing an S1. It is more of a retail product, which can be good. Right now in the market, there's more retail interest. They're looking for opportunities. It seems in the institutional is looking to kind of hold back the risk and are more hesitant. As long as the company's meeting our listing standards and registers with the SEC, which is that 8A12B, then they can list on NASDAQ.
What is the absolute tiniest company that could ever list? I mean, what is the absolute minimum? Do I have to have $50? Do I have $50 million? What is the tiniest company that could actually list with you?
Yeah, I mean, the perception is that you need to be a company generating $100 million in revenue and hundreds of employees and well seasoned. It's not the case, especially with lending standards a little bit more tight with the banking crisis. You can have a company and list on NASDAQ and have $5 million in shareholders' equity. So that's on a pro forma basis. So if your private company balance sheet doesn't have $5 million in shareholders' equity right now, you add the proceeds in the Reg A offering, and on a pro forma basis, if you have it, you've met that listing standard. Also, you need to have $15 million in the market value of the public float unrestricted. So not the market cap, but minus insiders and holders of 10% or more. And then also it has to be unrestricted. Can't be locked up. And then 300 round lot unrestricted shareholders. So you don't have to be profitable. The standards are even a little bit less from a market value of the public float basis if you have profitability, but that would be a company that doesn't have profitability. So essentially a company with a 20 million market cap, as long as they price their offering at $4 above and meet those other standards, can be listed on NASDAQ.
Now, Lou, a lot of these little companies that don't really have experience in the public markets have gotten interested in Reg A, and they think it's like, well, that's going to be real easy because it's cheaper and I can raise money without much trouble. why don't you address what it would be like for a new company to talk to you about doing a Reg A, and how does it compare to an S1? And the costs and things. Some questions are coming up about, is Reg A cheaper, faster? I mean, what's the advantage, the real advantage of it, number one? And then number two, address the differences in some of the, compliance issues with Reg A.
Sure. So the processes are very similar, particularly if your plan is to go up to NASDAQ. I think, as was pointed out by Andy, if you're using Reg A to go to NASDAQ, you're doing a tier 2, and you're using what is basically an S1 format to accomplish that. So you're providing essentially the same information that you'd be providing if you were doing an S1. So if a client came into me and said to me, I'm considering an IPO, what should I use, Reg A or S1? We'd go through an analysis as to what the benefit, the costs, benefits, and potential drawbacks are. And I think that there are, in fairness, some drawbacks, but we'll cover the benefits first. I mean, from a benefits standpoint, as Mark and Keith pointed out earlier, Reg A is a modernization of the listing process rules, of the registration requirements. When you look at the 250 series, which is rules 250 through, I think, 257 or 258 of the Securities Act, that comprise what is referred to as Regulation A, what you see is a very much more modern statutory framework. A lot of what the IPO process on an S1 is a process that's been built on since 1933, since the 33 Act was started. So you've got 90 years or so of built up rules, rule changes, tweaks to the rules, codicils, things like that. Whereas Reg A is a much more modern statute, and it was kind of completely overhauled a few years ago. So there are some fantastic features of it. I mean, the biggest one, I think, to my standpoint, there are two real strong advantages. One advantage is the ability to test the waters up front, just unlimited, and really do it through general solicitation. And as long as you have the proper disclaimer on there, which the rule mandates that, and I wrote it down, no money can be accepted. There are no sale commitments until qualification, and any indications of interest are non-binding. As long as you have that disclaimer, you can obviously, within the
Say, how many shares do you want, right?
Well, that, or you can talk about your company, and you can gauge interest, and you can ask for non-binding indications of interest, which, in the traditional S1 process is much harder to do, because you do have the quiet period, the waiting period, and until you actually have a registration statement that's publicly filed, it's much harder to take indications of interest. And even then, you're somewhat limited in what you can do. So Reg A is much more modern in that way. The other thing that's an advantage to Reg A, and this is, not necessarily if you qualify for NASDAQ, but if you're on the line for NASDAQ and you're worried that your offering may not qualify for NASDAQ, if you qualify to Reg A, qualified as opposed to registered under an S1, if you qualify to Reg A, you can technically go to the OTC if you don't qualify for NASDAQ. Whereas with an S1, that's much harder to do because of the state securities laws. Tier 2 of Regulation A provides you with an exemption from state blue sky filing, similar to if you were doing a Reg D Rule 506 offering. So there's a bit more functionality there. It's a much more, sort of streamlined set of rules. You've got the ability to do general solicitation, test the waters, things like that. I would say the only disadvantage to Reg A over S1 is perception. I think, despite the tremendous progress that people like Keith and Mark have made over the years, I think there is still a perception that a Reg A is a lesser offering than an S1. And so, a lot depends on who your investor base is. If your investor base is a primarily retail base and you're doing this through social media, things like that, the crowd, as Mark would say, then I think Reg A is a really good choice for you. If you're really looking to do more of the traditional format of an IPO, where your underwriter is really handling most of the distribution themselves, and they're looking to to bring in the usual mix of institution and retail, S1 may be a better choice for you, depending on who your underwriter is and who your potential investor base is. I'll let Andy speak to whether there's any perception difference between S1 and Reg A.
Well,
as far as NASDAQ.
here's the real key: investors. And I know, Keith, I'm going to put you on the spot here. You've said I've had trouble with some of my investors not wanting Reg A. And so why would that be? And have you seen them say, well, do they ever say, we don't care as long as you give us the money? I mean, what is the problem with Reg A that anybody would First of all, I think it's terrific, Reg A, because it's got so many more advantages over an S1 other than the amount of capital you raise. But why would investors say, I don't want to do a Reg A?
Yeah, great question. And just like we see certain investors don't invest in companies that are listed on the OTC, there are just certain investors that won't invest in companies that raise capital via Reg A. They want the fully underwritten, S1 or F1.
Can you have underwritten Reg A?
Essentially, yeah. I mean, it's the difference is the best efforts versus firm commitment. Mm-hmm. So with the underwriting process is very, as Lou mentioned, is very similar. The process is very similar. But certain and probably more institutional type investors, they just perceive that a fully underwritten firm commitment offering, pursuant to S1 or F1 is all that they will invest in. And those are, typically listed on NASDAQ or the NYSE. And so you just, when you go to market with a Reg A Plus offering, you just lose some investors that have, policy or a rule that they won't invest in other than a fully underwritten firm commitment offering. So we've actually explored doing firm commitment with Reg A Plus and really found the way to do it. So it's essentially a best efforts, which has, in my opinion, a lot of more flexibility. Mm-hmm. And the flexibility of Reg A Plus, the ability to raise capital on an ongoing basis has some real certain advantages to a registered S1 or F1. I kind of liken it to when you do a Reg A Plus, it's more like a marathon because you're just going along. When you do a registered offering, you get to the starting line and it's a sprint to the finish because essentially you have about a week to market it and close it. So it's, the selling period is much different under a registered firm commitment IPO versus a Reg A Plus. And
right.
We personally like the Reg A Plus offering. We just have an investor base that some of them just don't participate in them.
So Mark, here's the question. There's a thing called testing the waters in Reg A, which essentially means you can go out and take interest in it. Does that help you sell a Reg A at all? Is that a very good tool that you can go out, but you don't have a quiet period? You can go out and market it and see if there's interest and everything before you spend a fortune?
So the answer on the surface looks like it is. To me, it's a waste. Okay. It's something that we don't recommend. It gives misgivings to the management team because investors will put any number down and then management thinks they're getting all this money. In reality, it's not even close. But before I answer that, I want to just expand on what Keith was saying because it's important that what we're seeing in today's market over the last 6 months, we've been in one of the worst markets. 2022 was terrible. The number of IPOs basically grinded to a halt. Everybody on the street was looking for alternatives, and it went from issuer price deals to investor price deals. And what I mean by that is that it stopped being just a straight common stock deal, and now they're structured finance deals where they're units with sometimes even up to 200% warrant coverage. And we see these deals get priced at a significant discount to what the banker and what management wanted from a valuation standpoint. And as Keith mentioned, it's a sprint. You have a short period of time, and when you have price discovery, you're really left with no choice that you have to take the money. So we've seen our firm has picked up 2 transactions that were really good companies that were out on firm commitment IPOs that were with top tier banks, and they couldn't get the pricing that they wanted. And now they're flipping to a Reg A, which will now allow them to go to their customer base and their affinity groups. And there's one client, it has over 35,000 customers that buy their product that are very anxious to come in and buy. So what we're doing, instead of doing test the waters, is we're going to go right into an offering, because if you do test the waters, there's no call to action. All you're doing is asking somebody to indicate, and that's fine if it's a non-traded transaction. But what you want to do is have the ability, because although it's a continuous offering, there's still a line in the sand to list on NASDAQ. We set an offering period. Instead of a marketing time of 1 week, we set it up for 30 to 60 to 90 days. And depending on that calculation, we want investors to have a call to action where they hit a buy now button, they put their indication of interest in, they fund their account, and we set a closing date. And when it closes immediately. And as Andy had mentioned, you file an 8A and then it lists the next day. What we've done with Test the Waters is we've done Reg A's. We did one this past year where we didn't have a trade. We raised 20 million in essence as a bridge, and the bridge was the Reg A. There's a company that Matt and I are underwriting right now that the same thing occurred. I think, Matt, there was 38 million that we raised, and it was raised in previous rounds. And now the IPO, all those were either Reg A's or Reg CFs, and now the IPO is going to be a Reg A again. So it's a great way to use as an intermediary bridge and an ability then to sell the offering directly. And in terms of investors from the street, probably don't want those investors. That the ones that say no to Reg A's are the ones that want to do structured deals. The ones that are open-minded, and what we found now, because they perform well in the aftermarket, since you don't have artificial pressure from somebody selling the common, holding the warrants, you're now getting a better tier of investors who recognize this is the future of small cap underwriting.
Yeah. Now, Matt,
To me, that's the. Or do you mind if I jump in, Gene?
I want to ask you a question about that.
All right.
Obviously, when you have a listing on DealMaker, it has a very heavy marketing component most of the time through traditional marketing methods, advertising and things like social media, whatever. Can you explain how that exactly works with working with Mark or working with a broker?
Yeah, of course. So I guess one of the keys that I want people to retain, if they remember one thing from this panel, raising capital requires a strategy. Mm-hmm. Right? It requires a strategy. And so I think a number of panel members have kind of, touched on this in their own way. But like when you think about how to raise capital, where you can raise capital, S1, Reg A, you're really trying to answer the question of who do you think the buyers are going to be?
Exactly.
Anytime you sell something, who do you think is going to be the buyer?
Right.
And different buyers have different profiles.
Right.
And so, Mark's commented on that. Keith has commented on that too. And I think you mentioned it as well. At the end of the day, there are companies out there, and they know the people who are going to be interested in their story, who are going to get excited by what the company is doing. They meet a certain profile, and they may not be, investors who have wealth management accounts and who are going to be able to participate in an S1 registered offering. They may be, retail investors. It may be, I think someone in the audience was asking about a medical technology company. Mark and I have a medical technology company right now. And the people who understand and are excited by that company and who want to own a piece and who are going to be with that company, hopefully for many years supporting it, they're retail investors. And so the strategy for that company is to try to tell their story in a way that attracts those buyers. And that's marketing. I mean, that's engaging, it's building trust, it's being transparent with what they're doing, it's releasing video, it's releasing updates, it's, doing promotional activities. And it's something that founders know how to do, brands know how to do, because as I said in the beginning of my remarks, major brands out there have a newsletter following, they have an Instagram following. And so, when you do an offering with us, it means you've made a strategic decision that the likely buyers meet a profile that's better accessed through Reg A than it is through a more traditional interface. It means you think your buyers are more likely to be either individuals or small groups or professionals that you can target, you can identify and target and reach through the online tools of, Google ads, Facebook ads, all the social media platforms. And you can back it up by not just getting their attention, but winning their trust, providing content that they, that they come back for more of. And then just since I have the mic, I'm going to totally throw it in. I 100% agree with Mark. If you're going through the trouble of identifying that, that community as a source of capital, that's the strategy, then you just go and do it. You're going to get misleading information if you ask them how much they would invest theoretically rather than just saying invest now.
Now, Andy, we talking earlier about there's a new process for small IPO offerings that want to list on the NASDAQ. You got something new and different or changing, or what? What's the story there?
Yeah, so this was a reaction to some offerings back in mid-2022. So there were some smaller offerings where the share price skyrocketed, probably artificially pushed up and then fell right back down. And the regulators, noted that, and the SEC and FINRA, they're always worried about Joe and Jane, retail investor that may have bought at the high and got, it was manipulated up in the estimation of the regulators by a small group of investors that kind of controlled that demand. So, rather than them coming in and doing some sort of rule change, they came to the exchanges and said, you need to look into this more. You need to make this part of your review process. So for companies under 25 million in the offering, which would encapsulate most of probably the Reg A offering, we take a look at that allocation, that initial allocation. So leading up to pricing, I guess under a best efforts basis, maybe it'd be a little bit more difficult, but maybe leading into closing, you give us what that allocation is going to look like. And what they're looking for is not exactly defined. I guess they would certainly be looking for certain investors that were involved with other deals that didn't have price stability, that shot up and shot back down, or if it was concentrated really into a small group of investors, and then all the other retail investors had 100 shares each. So they're at that point, they're not denying the company from listing, they're just trying to give encouragement to make a better distribution in that allocation. So that's something that we've been doing for companies that have an offering under 25.
So here's
I know frustrations with Keith and some of the underwriters because that just delays the closing and the pricing, a day or two longer, and they've got to hold those investors, to their commitments.
So, Lou, how would I get started with a Reg A? If I'm a small company, what do I do first? I call up an attorney and ask them, what do I do? Or do I call up a broker first, or do I call a marketing company first? What would I do to try to get started with the Reg A?
Well, I would say that anybody or most of the people on this call, at least Mark, Keith, and I, would be a good place to start, possibly Matt as well. Yep, I said possibly Matt as well.
It's a no-brainer. It's a no-brainer.
Yeah, you could have, there are numerous entries. We have clients that come to us because their auditing firm, their accountant, suggested that they come to us. We have companies that come to us through various bankers where they did a private placement with a smaller brokerage firm, and that brokerage firm said, it's time to move up the chain. Very often they come to us first through word of mouth. You really just need somebody who has a place in this community, whether it be a banker, a lawyer, or an accountant who's familiar with the sort of the players in the space and what the requirements are. Generally a company that's interested in doing a Reg A plus has already done some private rounds, so they probably have some connections to Wall Street or Wall Street adjacent types of firms. And very often we'll get companies that are entering the IPO process in general, whether it's through Reg A or a traditional S1. These are companies that have maybe done one or two rounds of seed financing, early stage financing, Very often, this is going to sound crazy, but we get a lot of our referrals from other law firms that say, well, we'll do Reg D stuff. We'll do the private placement stuff. We don't do public stuff. So they refer things to us, and they start talking to us about the process. So, as I think was pointed out earlier, I mean, a lot of what can be done, we can do a lot of the preparatory process ourselves. We can prepare the Form 1A for you. We can get sort of all the materials together along with the auditors and the company. And then you can look for a banker, but oftentimes we're brought companies by the bankers who said, look, we're interested in this company, or we did an earlier round on this company. They're looking for a lawyer that's got experience in this, and they'll bring them to us. And the process is really the same, whether you're doing S1 or Reg A. You've got to put the book together, the registration statement or the offering statement if it's a Reg A. You've got to get your audited financials. That's usually the biggest gating issue. And you've got to assemble your team. And I mean, the core of the team is the banker, the lawyer, and the accountant. But there's also IR. There may be social media marketing companies involved. There's a number of things. Some companies now use NASDAQ consultants who are specific to NASDAQ. And I think Andy and everybody on this call knows who I'm talking about, that help go through the listing process. So, it's really, you put the book together, you put the team together. Those kind of happen in parallel. And then you enter the process. And that's very often by filing with the SEC initially, and opening up a new listing application on NASDAQ. So that's kind of how we get it started. Often we have companies that came to us sort of a little earlier than that. So we end up doing a private round, a bridge round for them, or one or two bridge rounds before they're ready to start paying for the cost of the actual public offering themselves. But yeah, I mean, anybody on this webinar would be a good entry point into the process.
Gene, let me add to that for a moment.
Yes, please, Mark, go ahead.
Yeah, I mean, Lou's talking about more from the legal perspective. So typically the investment banker, Keith and myself, will run book on this. We'll bring in all the service providers and the various market participants, whether it's going to be a syndicate book that we would build through the street. And then what we also do, work very closely with DealMaker, because one component to all of this to make it work, one component to the entire system is going to be the crowd-based digital marketing. So you need to have somebody that has the capability to reach an audience. Keith and I, as bankers, are not out there making videos to go out and go onto social media. We don't do media buys. What we do is we review the content.
We do.
And make sure that content is accurate and fair in its disclosure and not has forward-looking statements and promissory statements and things of that nature. But firms like DealMaker will come in and they complement. And the uniqueness of DealMaker, as an example, because we work with other non-traditional banks where they'll come in as syndicate to the crowd. But the beauty is being able to have a platform that can then facilitate the crowd-based side of the investment to complement what Keith and I do in the traditional Wall Street side, because that really is that convergence is what's going to make these deals work. And we're seeing now 80% of the money come from the crowd and 20% from the street. And I think until the market tends to strengthen in terms of investor demand from traditional Wall Street investors, we're going to continue to see that trend, which from an issuer standpoint, for everybody that's listening today, that's what you want, because somebody buying $500 to $2,500 of stock is going to be a long-term shareholder to allow you to execute. They're not buying it for a flip, where a traditional Wall Street guy might today, because they need to have liquidity to take advantage of these discounted prices on more traditional stocks. They'll be in it for just a short period of time and not give you as the CEO a chance to utilize those funds to grow.
Especially if they've bought stock at a discount, knowing there's an IPO coming and they plan to flip it, right?
Correct.
Yeah. Well, let's open it up to any more comments from anyone here. And you've seen some of the questions there that are coming in. There is one question. People want to know, what is a realistic budget? In other words, what should I plan on for doing a Reg A? Does anybody want to take that?
Well, it depends where you're starting from. So
let's say I'm a small company, and by the way, I think what Marcus and Keith are absolutely right that I would suggest you go to a broker first because they will tell you whether you have a financeable deal, right? And but what would be the cost?
See, Gene, I would actually disagree with that. I would say go to
Okay.
the lawyer first. And I'm not just saying that from self-serving, but once you go to one banker, it's maybe harder to move around. Whereas the lawyers, we tend to work with many of the bankers, and I think we have a pretty
Very
good
good
sense
point. Very good
of
point.
who fits. Certain bankers are better at life sciences, certain
Right.
bankers are better at tech, certain bankers are better at certain size offerings. So I know it sounds completely self-serving, but I would say go to the lawyer first.
Well, I can't disagree with you, other than that a lawyer might take your fee money, the money for the fee, whereas a broker is not going to take you on unless he thinks this is going to financeable.
Not necessarily true.
No? Okay.
There are some bankers that will charge you a due diligence fee. Nobody on this call, but there are definitely some banks that have a reputation of taking.
Oh yeah, they'll take
fees.
that due diligence fee, knowing full well that there's never going to be a chance of.
They'll string you along for a year,
I've
charging
seen
you
that
fees.
happen.
So yeah, I mean, but depends. Obviously, depends on who the participant is.
Right.
But just to kind of answer that one question, though, and a lot of the costs can come out of the offering themselves. But the things that we see that do take time and cost. One is the audit, and the audit is really kind of company or industry specific. The audit cost is. But that's typically a gating item to get your registration statement or the 1A on file, and obviously get it through the SEC. So that is a cost. But we found that there are many good auditors that provide great services at this end, at the lower end of the market, reasonable costs. So that's one cost to consider. Obviously, the legal costs. You'll have your SEC counsel like Lou and their fees, and then typically the underwriter or the placement agent will have its own counsel. Those costs get typically reimbursed, and then there'll be due diligence costs, and then the other variable there'll be listing costs or platform costs. But the other variable, and this is a real variable, is the marketing costs, and some companies spend quite a bit of money, in the hundreds of thousands of dollars, and some companies spend very little money. So those are all things to consider, in the cost of these types of offerings.
I agree. That's why I say, it depends on what you're starting from. Like we did the Green Bay Packers common stock offering, which was back in November 2021. They had a significant fan base. They spent, zero on marketing. That wasn't a Reg A. It was a little bit different. But, where a brand is at in its journey in terms of how much of a community has it built already. But, that Mark mentioned earlier, Monogram that we're doing together, they've been planning this for years. They've been building that community for years. And so, for them to do a Reg A, it comes on top of, a mountain of work that they've already put in to build their community through seed round and through Reg CF. If a company is significantly along in having built its brand and now wants to turn that community into a source of capital, then the budget's very different from if it's a relatively young company or, a founder with a track record that's looking to, through the campaign, grow its community and then turn it into a source of capital. And, Keith's right. We've had companies spend like $1 million a month with us building online campaigns to create a community and then turn it into a source of capital.
Yeah, what I'll add to that from the legal perspective is you will end up spending less on legal in general, probably 30%, around 30% less to do a Form 1A up to NASDAQ as opposed to an S1. I know our firm's fees are around a third less than you would on an S1, but as Matt and Mark and Keith have pointed out, you may end up spending that money on other things around the Reg A process that you wouldn't be spending on them in the S1 process.
I know some companies do a Reg CF to help test their fan base or their community or whatever, and then use some of that money to pay for the Reg A. Is that a good procedure, or is that maybe
Yeah,
not
that's very
good?
common. That's very smart. I think it goes back to something Mark said earlier. Testing the water. The best way to test the waters is to try and make a sale, right? So Reg CF lets you actually sell a security. You have a cap of 5 million, but we've seen that strategy deployed successfully. If you don't know what the response of the market is going to be to the offering, and you're still working out how to tell the story, and you've got a long offering period. You can run a CF for a year, and then once you've you're ready to graduate, then you can build on top of the learnings of the CF and go for a much larger capital raise through the A.
I know you've got a really excellent in-house marketing group, Reach, I believe it's called. And if a company doesn't have marketing for Reg A, you can basically be a one-stop shop, right?
Yeah, a lot of brands have their own team, but we do offer that full service capability to create content, shoot video, and help a company tell its story.
Great. So
let me just say one thing about all of this, because I can give you. So we're talking about what the cost is and what the benefits of raising capital, but there's another side of this that I think it's important that everybody understands, which is you're converting customers into shareholders, but you're also converting shareholders into customers. So it's a double edge. It's two bites at the apple, because you're out there creating brand loyalty and awareness for the offering. But at that same time, when you're digitally marketing for the sale of the security, you're also selling your product, because you're getting it out in front of people that have never heard of you or seen you.
right.
When we did the Myomo IPO, that was the first one that we did. It was for an exoskeleton robotic arm med device company. And I got literally for a year and a half after that, people calling me up saying, I never knew this product existed. And I had, my father, my friend, my uncle, whoever it might have been, family member, had mobility issues, and they discovered the product because of the Reg A, and they were able to get relief. So it showed that the brand in that particular company, their revenue increased directly because of the result of that Reg A introducing the product to a community that never heard from it. We did Fatburger. I think when we did it, it was 370 million in revenue. Top line system-wide sales now is between 2 and 3 billion. And in a short period of time, they've been able to raise almost $2 billion in capital through debt financings and equity, and really use Reg A to touch it off. And now we're able to, and they're a NASDAQ listed company, that we're quite successful utilizing Reg A to build that brand expansion. So there is benefit beyond just capital.
Well, we've got 7 minutes left, and I'd like to go around and have everybody tell how people can get in touch with you and what you're looking for. Don't call me if you're one of these or whatever. So Andy, we'll go clockwise around. And are you looking for some Reg A offerings?
Sure. We're looking for any company that can meet our listing standards. So there's the quantitative, the published financial and liquidity requirements for our listing, and then there's the qualitative side to make sure that there isn't any sort of public interest concern, which could be bad for the integrity of the market. So we're looking for any company that can meet those standards. With the listing, I know the title is crowdfunding for Reg A direct to NASDAQ. There's another listing venue as well. Since there's only two of us, if you're under 200 million, it's probably NASDAQ versus NYC American. If you're above 200 million market cap, you can probably list or have a shot at listing on the NYC primary. Talk to us both, right? It's just a 2 or 3 horse race. You might as well hear what each one has to say.
And Mark, you want to tell everybody how to get in touch with you?
So you feel free to reach out to me at Mark I'm at Digital Offering. You can find me on LinkedIn too. That's a great way to connect with me. My email is melenowitz@digitaloffering.com, but I'm sure somebody will circulate that after this. The one thing I'll tell you, Andy just touched upon it. And I think just the theme that we want to say is we get a lot of companies that come. Gene knows Keith and I are both kind of the land of no. It's not that we don't want to do the deal, but we're not groups that go out and collect retainers, we get paid on success. So we want to ensure that the companies that we get involved with are going to have a path to a closing, because there's a lot of time, there's a lot of expense, and there's a lot of effort that goes to these. And if you can't close a deal, then it's really not worth doing the deal. So we look for companies. I particularly like consumer, entertainment, or hospitality, something that has a large fan base, customer base, or affinity group. And I also like a story that you can understand in 30 seconds. If you have to explain how that molecule is going to cure cancer and it's going to take you 45 minutes of technical data to explain it, you've already lost them. But if you're buying a burger and you love the way it tastes and you want to have the sizzle, it makes sense. Those are the type of deals that we look for.
Keith?
Yeah, I saw some of the questions we're asking, from the investor standpoint, and I don't think we really touched on that enough. But as an underwriter or placement agent, we really have two constituents. We have the company that's seeking capital and the investors that provide it, and so we have to balance that. But I talk about what I call the financial circle of life, which is you invest in a company privately and exit publicly. And I've done that over and over again in my career. It's actually how I started the firm, because I was part of a team that used the capital markets, first privately and then publicly, to create a lot of value. And so that's, the opportunities we look for. But we are very sensitive to the investor having an exit strategy or having an exit opportunity. And so I think sometimes when we see Reg A Plus offerings, the company doesn't think enough about from the investor perspective and how do they exit, right? And so, this panel is all about, Reg A direct to NASDAQ, and that's a great potential exit, because the worst thing you can be is a minority investor in a private company. And so if you don't have a path of liquidity for your investors, makes it much more difficult to raise the capital. And again, under Reg A Plus, we're talking about investors who are both accredited and non-accredited, and most of them many times are non-accredited. So it's just something to keep in mind when you're embarking down the Reg A Plus path. And I'll send my email to everybody in the chat so you have it there. But
And,
please
Lou?
reach out. And Gene, thank you very much.
Sure. Lou, we got 2 minutes.
Okay. Yeah, no problem. I'll try not to take all of it. I just posted my email. Always happy to talk to companies that are looking to enter the public markets. That's what we do at HTFL. I would say don't come in with any preconceived notions. Reg A Plus is a tool. It's a tool in the toolbox. And chances are, if you are going to be a public company, you're going to use several tools. You might use Reg D, you might use Reg CF, you may use Reg A, you may use the traditional registration process. And I would say don't come in with preconceived notions. Talk to people that have done the process before. Just about everybody on this call is able to, operate within any number of deal structures. And it's a matter of finding the deal structure that's right for you. Some deal structures, some companies, as Mark pointed out, lend themselves better to Reg A Plus. Others may lend themselves better to the more, quote unquote, traditional IPO process. And it's not that one is better or worse than the other. It's about finding the right fit for your company, your shareholder base, your investors.
Yeah. And Matt, you want to wrap it up?
Yeah, I think those points are perfect. I don't disagree with any of them. I think at the end of the day, it's all about strategy, giving some thought to, where you want to go, what's the right fit for you. For us in particular, we're looking for companies who are building a community, whether they're going to do a raise in the near term, medium term, or long term comes second. What comes first for us is that they've got the wherewithal to build a community. And as Mark said, that means not just a capital raising strategy, also a product marketing strategy. And we'll cross the bridge as to, when they raise and how they raise and where they raise a little bit later on.
That's great. I'm Gene Massey with MediaShares, Gene, Gene, at MediaShares.com. And we want to thank all of you for coming today. And there will be a recording. If you're registered, you'll have access to that. And we want to thank the speakers for coming today, and Matt especially for hosting this. And we hope to see you on the next one. We'll have another good one in the near future.
Thanks, everyone.
Thank everyone.
Thanks, everybody.
Thank you.
Thanks all.
Bye-bye now.